Welcome to vTalkInsight, Allocator's Lens Daily for March 26, 2026. Cross-asset positioning is being pulled between a deepening stagflation scare and surprisingly resilient earnings, while energy and geopolitics keep volatility elevated and correlations unstable. Let's start with equities, where the tension between oil shocks and AI-driven growth is most visible. In equities, the central question is whether strong earnings and powerful AI themes can keep absorbing an energy-driven stagflation shock. U.S. corporate earnings have held up through a series of shocks, from the pandemic to high inflation and aggressive rate hikes, and analysts have nudged S&P 500 estimates up by about 2% over the past month. Expected earnings growth in the low teens, helped by AI-related efficiency gains and data center investment, is providing a fundamental backbone even as macro data softens. Beneath the index, leadership is slowly broadening beyond megacap technology. Semiconductor names are supported by an exceptional capital expenditure cycle from hyperscalers, with plans for hundreds of billions of dollars in spending that also pull in utilities and industrials tied to power and infrastructure. Emerging markets, such as South Korea and Taiwan, are favored over Europe in this semiconductor upswing, while high-profile stories like ARM's push into its own AI chips in anticipation around a potential SpaceX listing reinforce the sense that equity markets still have powerful growth narratives to trade. At the same time, investors are becoming far more selective. Within AI, capital is gravitating toward companies that can clearly link spending to revenues and costs, rather than anything with an AI label. And some memory chip makers are under pressure as new algorithms hint at lower future demand. Energy costs are squeezing fuel-intensive sectors. Airlines are raising fares and cutting capacity. Low-cost carriers face margin pressure, and U.S. households are diverting billions more each month to gasoline, which may sap discretionary spending and, over time, parts of the earnings story that have looked most resilient. Price action reflects this push and pull. The S&P 500 is still finding support, trading above key longer-term trend levels at times. Yet implied volatility sits in the mid-20s, with intraday swings amplified by day traders and very short-dated options activity. Recent equity gains have leaned heavily on hopes of de-escalation in the Middle East and on event risk, such as a potential SpaceX filing, even as some observers highlight a disconnect between upbeat equity pricing and ongoing energy restrictions in Asia, plus reports of unusually well-timed index derivatives trades that raise questions about market integrity. For allocators, the equity outlook now hinges less on broad beta and more on how quickly energy pressures feed into margins and whether the current earnings upgrade cycle can survive a slower, more inflationary growth backdrop, which brings us naturally to rates. In rates, markets are wrestling with a policy mix that looks higher for longer at the front end, but with growing uncertainty about how much further tightening central banks are willing to contemplate. For the Federal Reserve, recent commentary points to a high bar for additional hikes and a preference to stay on hold while assessing the impact of the latest energy shock on activity and inflation. Despite markets having largely priced out rate cuts for the second half of the year, the committee still anticipates at least one cut this year and more next year, though timing is vague and the neutral rate is judged to be above current levels, which keeps the easing path cautious. In Europe, the European Central Bank is emphasizing flexibility, taking decisions meeting by meeting, but it continues to treat its 2% inflation objective as non-negotiable. Scenario work there highlights how a severe, persistent energy shock could leave inflation roughly 3 percentage points above target well into January 1st, 2027, with growth weaker into January 1st, 2028, and officials have signaled they would tighten more forcefully if inflation expectations looked at risk of drifting away from target. In the UK, headline inflation has fallen, but core and services measures are still coming in a touch hot, and manufacturing input costs are rising at the fastest pace in decades, sustaining debate about how high the Bank of England ultimately needs to take rates. This policy ambiguity is shaping positioning. Portfolio managers are rotating out of emerging market fixed income and into short-duration U.S. Treasuries to capture relatively attractive yields while limiting exposure to both inflation and rate volatility, and many are cutting overall duration to guard against further commodity-driven price shocks. Recent Treasury auctions, where dealers had to absorb the largest share since 2020 and demanded higher yields to do so, underline a mix of risk aversion and questions about balance sheet capacity in the system. With bond market volatility elevated and oil still the key swing variable for inflation paths, the interaction between rates and equities remains tight, and that feeds directly into credit conditions. Credit markets are increasingly defined by a split between relatively orderly public markets and growing strains in private credit. Large private credit funds have imposed withdrawal caps, often limiting redemptions to around 5%, as family offices and high-net-worth investors rush to pull money from products they assumed were more liquid. Persistent redemption pressure is raising concerns about a potential feedback loop of forced asset sales in tighter terms, while at the same time banks such as Barclays are scaling back asset-based lending to smaller borrowers after losses, signaling more caution toward less regulated segments. By contrast, many institutional investors with long-term liabilities, especially insurance companies, continue to increase allocations to private equity and private credit, even as retail flows turn volatile. For these buyers, wider spreads and a steady inflow profile make higher-yielding private assets look comparatively attractive versus public equivalents, provided liquidity needs are well understood. The key open question is whether stress around retail and semi-liquid vehicles can remain compartmentalized or whether it starts to spill over into funding markets and bank balance sheets more broadly. All of this adds up to tighter credit conditions at the margin, on top of already higher policy rates and slowing growth. Public investment grade and high-yield indices still benefit from demand for carry, but spreads have edged wider from very tight starting points, and more investors are stepping back from trading altogether because of perceived market irrationality. For allocators, monitoring redemption trends in private vehicles, bank lending standards, and default data is becoming as important as watching headline spreads, because these channels will influence how quickly rate and energy shocks transmit into the real economy, and they interact closely with currency and safe haven dynamics. Turning to foreign exchange, the U.S. dollar remains the anchor of the current regime. It has appreciated since the outbreak of conflict in the Gulf, supported by high-quality carry, relatively resilient U.S. growth, and weakness in Europe and parts of Asia, and currencies such as the Brazilian real and Mexican peso also continue to offer attractive carry in a volatile world. Despite periodic calls for a weaker dollar ahead, there is little evidence of large-scale hedging against dollar downside or foreign selling of U.S. assets, and some research even favors the UK front end over U.S. equivalents on the view that the Fed is likely to cut before the Bank of England. The safe haven complex around FX is also evolving. Gold itself is still viewed as a portfolio diversifier, and, after recent pullbacks, some see the metal as more attractive than gold miners, although its performance in the latest risk-off episodes has been muted, partly because positioning was crowded going into the shock. Bitcoin's correlation with gold has dropped to the lowest level in several years, and digital assets are increasingly being slotted into diversified hedge baskets, even if their behavior during geopolitical stress does not yet match traditional havens. For currency allocators, that means hedging is no longer a simple choice between the dollar and gold. It involves balancing carry, liquidity, and correlations that can shift quickly when oil or policy expectations move, which brings us back to the commodity complex. Commodities, and oil in particular, remain the fulcrum of the macro story. Physical markets in the Middle East and Asia are extremely tight, with regional oil benchmarks well into triple digits, jet fuel prices quoted around $200 per barrel, and gasoline not far behind, reflecting both constrained supply and a hefty geopolitical risk premium. Shipping through a key Gulf Strait is technically still open but heavily restricted, with hefty new transit fees per voyage, and there is ongoing concern that physical damage to energy infrastructure could leave capacity offline for months or even years, lifting the long-run floor for prices. The spillovers into the real economy are classic stagflation territory. Airlines are facing sharply higher fuel bills, cutting capacity and planning fare increases on the order of 20%, while low-cost carriers see their competitive advantage eroded. Air freight rates from Asia to the U.S. have roughly doubled as capacity from Middle Eastern carriers shrinks. Dow Chemical is more than doubling planned plastics price hikes, and U.S. consumers are on track to spend an additional $12 billion a month on gasoline, likely cutting back on travel and services in response. Recent purchasing manager surveys already show weaker output but higher prices, and European consumer confidence has dropped more than after some past geopolitical shocks, underscoring the downside growth risk. Yet even here, the picture is two-sided. Oil prices have recently slipped back below $100 as diplomatic efforts around Iran raise hopes of de-escalation, with major benchmarks down several percentage points, which has helped ease near-term inflation fears and supported a risk-on tone in equities. At the same time, market commentary stresses that risk assets still react very sharply to oil levels, with selling pressure intensifying when benchmarks move much above $105 and conditions stabilizing below the mid-90s. There is also an uneasy disconnect between very tight physical conditions and calmer headline prices, amplified by reports of unusually well-timed trades in oil and index derivatives ahead of geopolitical announcements, which could invite tougher regulatory scrutiny. For multi-asset allocators, that means commodities remain the key swing factor for growth, inflation, and policy, and a significant source of event risk that will shape the cross-asset backdrop in the weeks ahead. Across assets, today's picture is one of resilient earnings and a firm dollar trying to offset an energy-driven stagflation scare, with central banks cautious and pockets of credit and liquidity stress emerging. Equities are leaning on AI and IPO narratives. Rates are pinned by higher-for-longer front ends. Private credit is wrestling with redemptions. Currencies are rewarding carry, and commodities, especially oil, remain the main swing factor for growth, inflation, and overall risk appetite. Key watch points for allocators include the path of Middle East tensions and oil prices, incoming inflation data and policy meetings, and any escalation in private credit strain or market liquidity fractures. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.